You know what's fascinating? While everyone's been watching the stock market hit new highs and crypto making headlines, something absolutely extraordinary has been happening in the gold market. And I'm not talking about just another price move. I'm talking about a fundamental shift in the global monetary system that's playing out right now in real time, and most people have no idea it's even happening. Let me show you what I mean. Gold just crossed a threshold that hasn't been seen in over 50 years. And when I say threshold, I'm not talking about a price level. I'm talking about gold's relationship with the dollar reaching a breaking point that central banks around the world have been quietly preparing for. Here's what caught my attention last week. The World Gold Council released their latest data, and it showed something remarkable. Central banks purchased over 1,000 tons of gold in 2024. That's the second highest annual total on record. But here's the kicker. They're not slowing down. In fact, they're accelerating. And when you dig into who's buying and why, the picture becomes crystal clear. China's central bank has been adding to its gold reserves for 18 consecutive months. 18 months. That's not a coincidence. That's a strategy. And they're not alone. Poland just announced they're increasing their gold reserves to 20% of total reserves. 20%. Turkey's been buying aggressively. India's been buying. Even countries you wouldn't expect, like Singapore and the Philippines, have been steadily accumulating. Now, you might be thinking, okay, central banks buy gold, they've always bought gold. What's the big deal? Here's the big deal. These aren't just purchases. These are strategic repositioning moves, and they're all happening at the same time. When you see coordinated behavior like this across multiple countries, across different political systems, across different economic situations, you have to ask yourself, what do they know that we don't? Let me take you back to 1971 for a second. August 15th, 1971. President Nixon closes the gold window. The dollar is no longer convertible to gold. The Bretton Woods system collapses. And for the next 50-plus years, we've lived in a world of pure fiat currency, where the dollar reigns supreme as the global reserve currency, backed by nothing but faith in the U.S. government. That system has worked remarkably well for the United States. We've been able to run massive deficits, print unlimited amounts of money, and export our inflation to the rest of the world. Why? Because everyone needs dollars to buy oil, to settle international trade, to hold as reserves. It's been the ultimate privilege. But here's what's changing. That privilege is being challenged in ways we haven't seen since the 1970s. And gold is at the center of this challenge. Think about what's happened over the last few years. Russia gets hit with sanctions. Their dollar reserves get frozen. Overnight, hundreds of billions of dollars that they thought were safe, that they thought were theirs, become inaccessible. Now, whether you agree with those sanctions or not, if you're a central bank in another country watching this happen, what's going through your mind? You're thinking, if it can happen to Russia, it can happen to us. And suddenly, holding all your reserves in dollars doesn't seem like such a safe bet anymore. Suddenly, you need an alternative, an asset that can't be frozen, can't be sanctioned, can't be controlled by any single government. And there's only one asset that fits that description: gold. This is what I call the de-dollarization trade. And it's not some conspiracy theory. It's happening in plain sight. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing alternatives to the dollar for years. They've been working on payment systems that bypass SWIFT. They've been settling trade in their own currencies. And they've been buying gold. Lots of gold. But here's where it gets really interesting. It's not just about geopolitics, it's about mathematics. The U.S. national debt just crossed $36 trillion. $36 trillion. That number is so large it's almost meaningless. But let me put it in perspective. That's over $100,000 for every man, woman, and child in America. And it's growing by roughly $2 trillion every single year. Now, how do you service that debt? How do you pay the interest on $36 trillion? Well, you print more money. The Federal Reserve creates dollars out of thin air and buys treasury bonds. It's a beautiful system if you're the one with the printing press. But if you're a foreign central bank holding those treasury bonds, watching the money supply expand, watching the debt grow, you start to get nervous. Because here's the thing about fiat currency. It only works as long as people have confidence in it. The moment that confidence cracks, the whole system can unravel remarkably quickly. And gold is the canary in the coal mine. When gold starts moving, when central banks start accumulating, when the price starts breaking out to new highs, it's telling you something about confidence in the system. Let me give you a specific example. In 2023, gold hit a new all-time high of over $2,000 per ounce. But here's what was strange about that move. Normally, when gold rallies, it's because the dollar is weak. Gold and the dollar typically move in opposite directions. But in 2023, gold was rallying while the dollar was strong. That's unusual. That's telling you something different is happening. What's happening is that gold is decoupling from its traditional relationship with the dollar. It's no longer just an inflation hedge or a safe haven during dollar weakness. It's becoming something else. It's becoming a strategic reserve asset that central banks want regardless of what the dollar is doing. And that changes everything. Now, let me talk about the supply side for a minute, because this is crucial. Gold is unique among commodities. The total amount of gold ever mined in human history is estimated at around 200,000 tons, and about half of that is in jewelry, about 20% is in central bank reserves, and the rest is in bars and coins held by investors. Here's the key point. Gold production is essentially flat. The easy gold has been mined. New discoveries are rare. And it takes years, sometimes decades, to bring a new mine into production. Meanwhile, demand is surging. Central banks are buying, investors are buying, and the physical market is getting tighter. You can see this in the COMEX data. The COMEX is where gold futures are traded in the United States, and there's been a fascinating trend over the last year. The amount of physical gold backing those futures contracts has been declining. At the same time, the number of contracts representing claims on that gold has been increasing. In other words, there are more paper claims on gold than there is actual physical gold to back them up. This is what's called the paper gold market, and it's massive. For every ounce of physical gold, there are estimated to be 100 ounces of paper gold, futures contracts, ETFs, derivatives, and as long as everyone's happy holding paper, the system works fine. But what happens when people start wanting physical delivery? We got a glimpse of this in March 2020 during the COVID panic. The gold futures market nearly broke. The spread between the futures price and the physical price blew out to unprecedented levels. Why? Because there was a scramble for physical gold, and the paper market couldn't deliver. The system came within days of a complete breakdown. Now imagine that happening again, but on a larger scale. Imagine if central banks, who currently hold about 35,000 tons of gold, decide they want to increase that to 50,000 tons. Where's that gold going to come from? Annual mine production is only about 3,000 tons. The math doesn't work. Something has to give. And what gives is the price. This is the setup we're looking at right now. Surging demand from central banks. Flat supply. A paper market that's increasingly disconnected from physical reality, and a dollar that's losing its monopoly on global reserve status. All of these factors are converging at the same time. Let me tell you about something else that's happening that most people aren't paying attention to. The Shanghai Gold Exchange. This is where physical gold is traded in China, and the volumes on the Shanghai Exchange have been exploding. In fact, China is now the largest physical gold market in the world, bigger than London, bigger than New York. And here's what's significant about that. The price on the Shanghai Exchange is often higher than the price in London or New York, sometimes significantly higher. That's called a premium. And what it tells you is that there's strong demand for physical gold in Asia that's not being fully reflected in the Western paper markets. This creates an arbitrage opportunity. Traders can buy gold in London or New York, ship it to Shanghai, and sell it at a premium. And that's exactly what's been happening. Gold has been flowing from west to east for years now. The vaults in London have been draining. The vaults in Switzerland, which is where gold gets refined before being shipped to Asia, have been working overtime. This is a one-way flow. Gold that goes to Asia doesn't come back. It gets absorbed into the Chinese and Indian markets, into jewelry, into bars held by individuals, into central bank reserves. And this flow has been accelerating. Now, let's talk about what this means for the dollar. The dollar's status as the global reserve currency has given the United States enormous advantages. We can run trade deficits indefinitely because other countries need to accumulate dollars. We can sanction other countries because they need access to the dollar system. We can keep interest rates lower than they otherwise would be because there's constant demand for dollar-denominated assets. But what happens when that demand starts to fade? What happens when countries start settling trade in yuan or rupees or even gold? What happens when central banks start diversifying away from dollars and into gold? The answer is that all those advantages start to erode. You start to see higher interest rates because there's less demand for treasury bonds. You start to see inflation because the dollars that were being held overseas start coming back home. You start to see a loss of geopolitical influence because the threat of sanctions becomes less effective. This is the endgame that gold is signaling. Not next week, not next month, but over the next decade. A gradual shift away from dollar dominance and toward a more multipolar monetary system. And in that system, gold plays a central role. Now, I want to pause here for a second because if you're sitting on $100,000 or more in retirement accounts, this is something you need to be thinking about. How do you protect your wealth in a world where the dollar's purchasing power is being eroded? How do you position yourself for this shift that's happening? One option that a lot of people don't know about is a gold IRA. This is a way to hold physical gold inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how this works, what the rules are, what the costs are. It's in the description below. If this is relevant to your situation, it's worth checking out. All right, back to where this is all heading. Let's talk about price targets, because that's what everyone wants to know. Where is gold going? Well, if you look at gold's previous major bull markets, they tend to move in stages. The first stage is the stealth phase, where gold is quietly accumulating while most people aren't paying attention. That was roughly 2018 to 2022. The second stage is the awareness phase, where gold breaks out to new highs and starts getting mainstream attention. That's where we are now. And the third stage is the mania phase, where everyone wants to own gold and the price goes parabolic. In the 1970s bull market, gold went from $35 to $850. That's a 24 times increase. In the 2000s bull market, gold went from $250 to $1,900. That's a 7.5 times increase. Now, I'm not saying gold is going to go up 24 times from here, but even a more modest move, say a doubling or tripling from current levels, would take gold to $4,000 or $6,000 per ounce. And if we get a real crisis, if we get a loss of confidence in the dollar, if we get a scramble for physical gold, those numbers could be conservative. Some analysts are talking about $10,000 gold. Some are talking about even higher. Now, those sound like crazy numbers, but remember, gold isn't really going up. The dollar is going down. Gold is just maintaining its purchasing power while the currency loses value. Think about it this way. In 1971, when Nixon closed the gold window, gold was $35 per ounce. Today, it's over $2,600. That's a 74 times increase. But has gold really gone up 74 times? Or has the dollar lost 99% of its value against gold? It's the same thing, just a different way of looking at it. And here's the thing. That process isn't over. In fact, it might be accelerating. The money printing that happened during COVID, the massive fiscal deficits, the political dysfunction that makes it impossible to address the debt problem, all of this points to more currency debasement ahead. Let me give you another data point. The M2 money supply, which is a measure of the total amount of dollars in circulation, increased by 40% from 2020 to 2022. 40% in 2 years. That's unprecedented outside of wartime. And while the Fed has been trying to reduce the money supply through quantitative tightening, we're still well above pre-COVID levels. All those dollars have to go somewhere. Some of them went into stocks, which is why the stock market has been so strong. Some went into real estate, which is why housing prices have been so high. And some are starting to go into gold. But here's what's interesting. Gold's market cap is still relatively small compared to other asset classes. The total value of all the gold in the world is around $15 trillion. That sounds like a lot, but compare it to the stock market, which is over $100 trillion, or the bond market, which is over $130 trillion, or real estate, which is over $300 trillion. If even a small percentage of the money in those other asset classes shifts into gold, the impact on the gold price would be enormous. And that's exactly what we're starting to see. Institutional investors, pension funds, sovereign wealth funds, they're all starting to allocate to gold in ways they haven't before. There's also a generational shift happening. Younger investors, millennials and Gen Z, they didn't live through the 1970s inflation. They didn't see what gold can do in a crisis. But they're starting to learn. They're seeing the purchasing power of their dollars eroding. They're seeing housing become unaffordable. They're seeing the cost of living skyrocket, and they're looking for alternatives. Some of them are going into Bitcoin and crypto. And that's fine. Crypto has its place. But gold has 5,000 years of history as money. It's survived every empire, every currency, every financial system. It's the ultimate long-term store of value. And as more people realize that, as more capital flows into gold, the price is going to reflect that demand. Now, let me address something that gold skeptics always bring up. They say gold doesn't produce anything. It doesn't pay dividends. It doesn't generate cash flow. It just sits there. And that's true. Gold is not an investment in the traditional sense. It's insurance. It's a store of value. It's a hedge against the system. When you own stocks, you're betting on companies to grow and generate profits. When you own bonds, you're betting on borrowers to pay you back with interest. When you own real estate, you're betting on rental income and property appreciation. But when you own gold, you're not betting on anything. You're protecting yourself against the debasement of currency. You're opting out of the fiat system. And in a world where governments are running unprecedented deficits, where central banks are trapped between inflation and recession, where the global monetary system is being challenged, that insurance is becoming more valuable by the day. Let me tell you a story that illustrates this perfectly. In 1980, the average American home cost about $64,000. At that time, gold was at $850 per ounce, so you could buy an average home with about 75 ounces of gold. Today, the average home costs about $400,000. Gold is at $2,600 per ounce, so you can still buy an average home with about 150 ounces of gold. In other words, gold has roughly maintained its purchasing power against real assets over the long term, even though the dollar price of both gold and housing has gone up dramatically. That's what gold does. It preserves wealth across time, across currencies, across economic systems. And that's becoming more important as we move into an era of financial instability. The next 10 years are not going to look like the last 10 years. We're not going back to the low inflation, low interest rate, stable currency environment of the 2010s. We're entering a period of higher volatility, higher inflation, and potentially significant changes to the global monetary system. In that environment, you want to own real assets. You want to own things that can't be printed, can't be debased, can't be inflated away. And gold is the king of real assets. Here's another angle to consider: the mining industry. Gold mining companies have been underinvesting in exploration and development for years. Why? Because gold was stuck in a range between $1,200 and $1,800 for most of the 2010s. At those prices, many projects weren't economical, so companies focused on returning cash to shareholders rather than investing in growth. But now, with gold above $2,600, those economics have changed dramatically. Projects that weren't viable at $1,500 are highly profitable at $2,600. You'd think this would lead to a surge in production, right? But here's the problem. It takes 7 to 10 years to bring a new mine into production. You have to find the deposit, drill it out, do feasibility studies, get permits, raise capital, build the infrastructure. It's a long, expensive process. So even though gold prices are high now, we're not going to see a significant increase in supply for years. And by the time that new supply comes online, demand could be even higher. This creates a structural supply deficit that's very bullish for prices. There's also the grade decline issue. The average grade of gold ore being mined today is lower than it was 20 years ago. That means miners have to process more rock to get the same amount of gold. That increases costs, which puts a floor under the gold price. If gold falls too much, mines become uneconomical and shut down, which reduces supply and supports the price. This is very different from something like oil, where if prices go high enough, you can drill more wells and increase production relatively quickly. With gold, the supply response is slow and limited, and that asymmetry between supply and demand is one of the reasons why gold bull markets can be so powerful. Let me also talk about the jewelry market for a second, because this is a huge part of gold demand that often gets overlooked. India and China together account for about half of global gold jewelry demand. And in these cultures, gold isn't just decoration. It's savings. It's wealth. It's passed down through generations. When you go to a wedding in India, the bride is often wearing her family's wealth in the form of gold jewelry. When Chinese families save money, they often buy gold bars or jewelry. This cultural affinity for gold creates a baseline level of demand that's very stable and very large. And as these countries get wealthier, as their middle classes grow, that demand is only going to increase. We're talking about billions of people who view gold as the ultimate form of savings. That's a powerful long-term driver for the gold market. Now, let's bring this back to the dollar for a minute, because ultimately, that's what this is all about. The message that gold is sending to the dollar is simple. Your monopoly is ending. Your ability to print unlimited amounts of currency without consequences is being challenged. Your status as the unquestioned global reserve is being questioned. And the evidence is everywhere. You see it in the BRICS nations developing alternative payment systems. You see it in Saudi Arabia accepting yuan for oil sales. You see it in central banks diversifying their reserves. You see it in the gold price making new all-time highs while the dollar is supposed to be strong. This is a slow-motion shift, not a sudden collapse. The dollar isn't going to zero tomorrow. But over time, over years and decades, its role in the global economy is going to diminish. And as that happens, gold's role is going to grow. Think about what the world might look like in 20 years. Maybe international trade is settled in a basket of currencies rather than just dollars. Maybe central banks hold 30 or 40% of their reserves in gold instead of 20%. Maybe there's a new monetary system that's partially backed by gold, similar to Bretton Woods, but more flexible. We don't know exactly what the future holds, but we know the current system is unsustainable. We know the debt can't keep growing forever. We know the money printing has to have consequences. And we know that throughout history, whenever fiat currency systems have failed, gold has been there as the fallback. That's the message gold is sending right now. It's saying, I'm still here. I'm still relevant. I'm still the ultimate form of money. And no matter what happens to the dollar, to the euro, to any paper currency, I will still have value. For investors, for savers, for anyone trying to preserve wealth over the long term, that message is worth paying attention to. Because the game isn't over for the dollar yet, but the rules are changing. And gold is showing us what those new rules might look like. The question isn't whether gold is going higher. The question is how much higher and how fast. And the answer to that depends on how quickly confidence in the fiat system erodes, how aggressively central banks continue to buy, and how many investors wake up to what's really happening. But one thing is certain. Gold has sent a message, and that message is clear. The era of unchallenged dollar dominance is ending. A new monetary order is emerging, and gold is going to play a central role in that new order. The game isn't over. It's just entering a new phase. And if you understand what's happening, if you position yourself accordingly, the next decade could be one of the most profitable periods for gold in history.